Hello everyone. This video is associated with the Group 5 Cumulative Software Problem, specifically Chapter 5. I'm going to assume that you have the instructions on one tab of your browser, the ebook or the textbook set aside, the solutions to the Chapter 5 software problem, ProConnect, where you're actually going to be entering into the software. Let's go to the actual text itself. Chapter 5 is associated with deductions for and from AGI. And now let's go to the instructions. We'll blow these up a little bit. All right, so again, the direction we get is not to add a client, but simply copy the Chapter 4 tax return and rename it to Chapter 5. So let's do that. We'll go into ProConnect. We'll click on tax returns. You'll see the last tax return we worked on is Chapter 4. We'll go ahead and copy. Now we have Gator Chapter 4 copy, and now we're going to rename, and we'll refer to this as Chapter 5. We'll select and go into the Chapter 5 tax return. We'll end up at the profile. And let's just go ahead and assume we'll need to go into input because chances are that's what we're going to be doing. Let's go to the textbook, and immediately we're told that Albert and Allison received the following form. They received a 1098 mortgage interest statement, and included in that statement, we see that on box 1, $10,821.11 were paid for mortgage interest. Mortgage interest is a deduction from AGI, which whenever I say from AGI, that means it goes to what's called the Schedule A. The Schedule A is a accumulation of from AGI deductions. It is below AGI. So if it's below AGI, we call it from AGI. So let's go ahead and go back to ProConnect. And now we're going to look over in the section called deductions. Adjustments to income would be for AGI. Itemized deductions, Schedule A, will be from AGI. So let's click on itemized deduction. Here are the categories for the itemized deductions. We have medical at the top, showing all the medical expenses that may be deductible. We have taxes, we have interest, we have contributions, miscellaneous and other, and then less common items. Let's first go to the interest. The 1098 provided shows us that there was home mortgage interest paid. Let's go back to the textbook. It's $10,821.11. We'll enter that under the home mortgage interest and points on Form 1098. $10,821. Back to the textbook. After that, we have a listing of potential deductions, either for or from. They're listed here. These Albert and Allison paid the following in 2024. So all of these items may or may not be deductible. We have to go through each one and make a determination as to whether it is deductible. Okay, so the first item listed is contributions to St. Anne's Catholic Church. All churches are considered to be nonprofit organizations. They're not 501c3s, but they're definitely qualified as a charitable organization, which makes the contributions to churches and other charitable organizations deductible. So the $600 would be a deduction. Let's go to the tax return and look for contributions. Now that is a cash contribution. So at the very top, we'll see cash contributions. There's a 60% limitation in that you can only have cash contributions up to 60% of your AGI, your adjusted gross income. I don't think we're going to have any issues here, but the system can actually keep track of it, so we really don't have to worry much about it. We'll go ahead and click on plus, and St. Anne's Catholic Church, we'll go ahead and list that as the description. St. Anne's Catholic Church. The amount listed is $600. So we'll enter that and press OK. Go back to the textbook, and we have entered the contribution to St. Anne's Catholic Church. The next item listed is tuition to St. Anne's Catholic School for Crocker. St. Anne's Catholic School, there is no reference here to this being higher education. So a payment for tuition to a private school that's not higher education would not be deductible. So that $6,000 can be ignored. Let's go to the tax return, and then we'll look at non-cash contributions. There is a limitation of 50% in total. So we'll click the plus sign, and again, reference close to Salvation Army, $250. So to make it simple, we'll just call the description Salvation Army. And I think we said 250. Press OK. Now, if the actual contribution is greater than $500, there would be another form that would have to be attached. The form 8283, which is specific listing of non-cash contributions, would have to be completed, but it's only required if your non-cash contribution is over $500. We do not have to prepare the form 8283. We simply enter the $250. Okay, let's go back to the textbook. The next item listed is contributions to Marcus Rubio's congressional campaign. Generally speaking, contributions to congressional campaigns or any political campaign is not deductible. So we can ignore the Marcus Rubio congressional campaign contribution. Psychotherapy for Allison. Anytime you have a medical cost related that's required, non-cosmetic medical costs, they are considered to be deductible, subject to specific limitations, which we'll take a look at in just a bit. But we definitely want to enter this into the system. And the good news is the system will look at the limitations and help us figure out whether in fact it did become deductible or not. Psychotherapy for Allison, $1,200. Let's enter that into the tax return. We have medical expenses here. The categories listed are prescriptions, medicines, and drugs. That's not what we're referring to. Doctors, dentists, and nurses. We will consider psychotherapist as a doctor. So we'll enter that. Psychotherapy for Allison. And the amount listed was $1,200. Let's go back to the textbook. Prescription eyeglasses for Crocker, $400. Because Crocker is a dependent, then prescriptions eyeglasses would be deductible. It's $400. So let's go and enter that into the system. Prescriptions, medicines, and drugs. Let's put it there. We'll call it eyeglasses for Crocker. And the amount we're going to enter is $400. Back to the textbook. Prescription, medication, and drugs. The total was $1,900. That's definitely deductible. Let's go to the tax return, prescriptions, medicines, and drugs. We'll put that under there. We'll just put medication here. And the amount listed is $1,900. That's okay. Going back to the textbook, we just finished the prescriptions. Credit card interest, 1,345. There was a day when it was deductible. It was way back in the 80s. It is not considered to be tax deductible, specifically in 2024. Let's move on to the next. Actual state sales tax, including sales tax on new auto of 2,000. So the total was 3,750. Of that, 2,000 was associated with the new auto. Let's see. Let's go to taxes. The tab taxes, we'll click on it. We have state income taxes. Since they live in Florida and there's no state income tax, there wouldn't be any dollar amount associated. If they paid for state extensions or returns, anything associated with the state would go there. Again, here as well. City and local, if they have a city income tax, the example would be New York City. New York City has an income tax. Most cities do not, so definitely in Florida, they do not. The next section, sales and use tax, actual amount paid, except for autos. Well, we can do this a couple of ways. Let's go ahead and list the total as it's listed. Sales tax total. They gave us $3,750. But we're going to reduce that because we're actually going to put sales tax on automobiles in a separate area. So we'll subtract $2,000, which was listed on the tax return. So the net, what's going to end up, and we could have just entered it that way, state and local sales tax, we could have just entered $1,750. But now we'll look for the area where it has sales tax on autos, not included above, and we'll add that in here. In this case, we don't need to go into any detail. It's $2,000 for the auto. So we should be good to go. Going back to the textbook, investment interest expense on stock margin account, $300. We're going to go ahead and enter it in simply because they do have investment income that exceeds $300. So therefore, investment interest against investment income is deductible. If they had no income, then it would not be. But they do, so we're going to go ahead and enter the $300 in. Let's go to interest. Same section or area where we entered the home mortgage. We'll look for investment interest and we'll enter that $300. Going back to the textbook, auto loan interest reported on Form 1098. Not shown here, auto was paid for by a home equity loan on a residence. Okay, so even though they received a 1098, which would suggest that they have interest that's deductible, you have to be careful. If the money you pulled out on the home was used for something other than the home, then it's not deductible. In this example here, they pulled the money to pay for, in this example here, they pulled the money to pay for an automobile. That does not qualify. The interest that's incurred on that loan, even though it's reported on the Form 1098, will not be deductible. So we can ignore the $860. Auto insurance for $1,600. Auto insurance is never tax deductible. Cosmetic surgery for Albert, $3,200. Any kind of medical procedures that is cosmetic will not be deductible. So we can ignore that. Dave, deduction CPA for preparation of last year's tax return. In 2024, that is not a tax deduction. It used to be, as far back as 2017, a deduction, maybe, depending on the circumstances. But for 2024, it is definitely not tax deductible. Now, I'm going to give you a little bit of a heads up here. The changes that occurred in 2017 applied to the federal income tax requirements. Many times the state of California follows in sync with the federal government. This is an example of one that for state purposes, California would consider that to be a deduction depending on the total of what's called miscellaneous expenses. So just a heads up, if you're using tax software that includes the state of California, you probably would want to enter that simply to make sure that you account for it in the event that it's deductible for the state of California. Safe deposit box, again, no, but also maybe for the state of California. Contributions to an educational savings account for Crocker. Contributions to an educational savings is not going to be deductible. Now, there are some tax advantages for certain types of plans, like a 529 plan. That doesn't mean you shouldn't create the 529. You should, or could, and can. The initial contribution will not be tax deductible, but any growth that you have on that savings, any interest earned, or if there's investments, any increase will be not taxable even when you withdraw the money. So that's one benefit of a educational savings account under specific tax plans. Home property taxes, $7,000. That is definitely a tax deduction. Let's go to the tax return, look under taxes, and then put for property taxes, where's that listed at? We have income tax, sales and use tax, real estate taxes, there it is. Principal residence, again, the property tax is deductible on the principal residence. If it's under the principal residence, it'd be here, and the amount that was reported is $7,000. $7,000 is entered as real estate taxes, and that will be deductible. Let's go back to the textbook. Home property taxes, we've entered that in. Unreimbursed business expenses. There was a seminar dealing with hijacking at sea, and that would not be considered a deduction. Unreimbursed business expenses are not a deduction. Used to be back in 2017, but no longer is. Having said that, state of California would still consider that to be a deduction, maybe depending on how much you have in total. Okay, so that takes care of all of the deductions listed here. We also have a reference to a Form 1098E that is a student loan. Now, the student loan interest would be considered a deduction for AGI. In other words, it's above AGI. So let's enter that in a separate area. We're going to go back to the tax return. Everything we've entered so far has been under Schedule A. We're going to make this entry into adjustments to income. The textbook refers to it as for income, for AGI. Let's see. In that area, we have retirement, health insurance, and education. We're going to click on the educational tab. And let's go back to MindTap. Looks like it's 3,100 and $22.45. We'll round that, it's $31.22. Now let's go back and look at the textbook. This was for Albert. So Albert apparently is still paying on a student loan $3,122. So we'll enter that under the taxpayer, not the spouse, but the taxpayer. Total qualified student loan interest, $3,122. See some other things that are listed here. In August of 2024, Crocker was on an out-of-town field trip with the university band, and his appendix burst. He required immediate surgery, which was considered out of network for the Gators health plan. resulting in a hospital and doctor's fees of $4,600 not covered by insurance. So those are medical expenses not covered by insurance, definitely tax deductible. We will go to the tax return, we'll go back to itemized deductions under medical. We've got some flexibility here. There's when it actually flows through to the actual form, they don't distinguish between these items. Let's go ahead and put it in, since it appears to be emergency, it was probably done in a hospital. Surgery. Is that where you spell surgery? I think it's ERY. And the amount listed for the surgery, $4,600. Pressing OK. Let's go back to the textbook. In addition, Allison drove 320 miles round trip to be with Crocker after the surgery and drove him home after he recovered. So 320 miles, those are considered to be medical miles. They are also deductible. Now the rate they're going to be deducted at is much lower than the auto rate. It's about half, I believe. We're pretty close to half. It looks like for 2024, it was 21 cents. But in this case, we don't even have to worry about putting in the dollar amount. We just put in the medical miles driven. And again, we'll put surgery, and I think there was 320 miles. Is that what it was, 320? Yeah, 320 miles. So with this 320 miles, the system will compute the actual deductible amount. Okay, let's go back to the textbook. All right, now in addition to that, it appears Allison spent 2 nights in a hotel at a cost of $170 per night. That also would be deductible. However, there are limitations. Let's go back to the entry, and we'll put it under lodging, out-of-pocket expenses. Go ahead and list that as hotel for surgery. Now here we have to be careful because whatever we put in is what's going to flow through. So here we have to actually put, now if you read in your textbook, you can deduct the hotel costs, but it's only $50 per night per person, and that person is required to be there for support or whatever. If she would have brought a whole bunch of other family, it wouldn't have applied to them. But it's $50 per night per person, and in this case, it's only Allison. So 50. There were 2 nighs, so we're going to actually enter $100 for the 2 nights. All right. So we've got the $100 for lodging. We've got 320 miles for driving. Let's go back to the textbook. Oh, looks like it's taken care of. All right, in June, Albert purchased a new professional digital SLR camera for $7,950. While the Gators were on vacation in August, someone broke into the residence and stole the camera. Albert's homeowner's insurance did not reimburse him for any part of the loss since he declined the special premium add-on for high-valued items required by his policy. This may or may not have been deductible in 2017 or before, but after 2017, the law changed in that whenever you want to deduct a loss, it has to be in a federally declared disaster area. There wasn't a forest fire, there wasn't a hurricane in this case. It was just a stolen camera, so that's not going to be deductible. For the 2024 tax year on April 15, 2025, Albert contributes $7,000 to his traditional IRA, and Allison contributes $7,000 to her traditional IRA. And Allison contributes $7,000 to her traditional IRA. For clarification, Albert is not covered by a qualified retirement plan at work, so therefore, any contribution made to a traditional IRA for both Albert and Allison would be considered deductible. Now, this is for AGI. This wouldn't go into the Schedule A. It goes under the adjustments. So let's go back to the tax return. We'll go to adjustments. And you might have noticed it when we looked at adjustments. I think it was for education purposes. At the first tab is retirement. And in fact, the first row, IRA contributions, that's what's listed here. Taxpayer is going to deduct $7,000 and the spouse is going to deduct $7,000. All right, so we'll put $7,000 for both. Let's go back to the textbook. This is where we're at. That's where we left off. Albert managed to gather his gambling loss documentation and can substantiate gambling losses of $5,881 in 2024. Okay, now he had $5,881 in gambling losses. Now, gambling losses are deductible, but they are limited to gambling winnings. So before we put any dollar amount, we have to go and remember we entered it under income. It might have been, I think it was chapter 2. We'll have to go to income, and it was under gambling winnings and losses. We'll check on it. Gambling, Triumph Casino Cruises. Albert had gross winnings of 5,750. That is the limit to what can be deducted. Going back to MindTap, they said it was 5,881 in total gambling losses, but the limitation will be to 5,750. So that makes it easy. We'll go back to the deductions, specifically itemized deductions. Under miscellaneous and other itemized deductions, gambling losses to the extent of gambling winnings or winnings. The gambling winnings were 5,750, so that's what can be deducted. Going back to MindTap, we've entered the losses here. Let's move on to the next paragraph. As noted in chapter 4, the Gators sold their home in Sebastian, Florida in January 2024 and moved to Stuart, Florida so that Albert could work for Sport Fishing of Stuart. Stuart and Sebastian are more than 50 miles apart. The Gators did not receive any relocation stipend from Albert's new employer and paid $4,300 for the cost of moving household goods. They drove their car 70 miles during the move and incurred no other moving expenses or costs. Unfortunately, again, 2017 or before, that was potentially a deduction, but there's no reason to move any further with this because moving expenses are not deductible. Okay, so let's check and see how we did. I think we finished all the entries for deductions. Let's go to the tax return. And now let's go to review the return. And we're going to move this over to the left side. Now let's go to the solutions. And now let's move this over to the right side. All right, we'll start with the 1040. No changes to the top. No changes to filing status, digital assets, no changes there. No changes to dependents. And we'll quickly scan just to make sure everything still is in play. We want to look in case we accidentally made a change to something, but there was 1A 70,706. That still applies to 1Z. 2A 850. 2B 1422. Quality dividends 1850. 3B is 2100. So we're still good. 7 15,365. Line 7 capital gains 15,365. There was no changes to that. Additional income for line 8 13,819. Line 8 13,819. Just moving on to 9, it's 103,412. Just I'm looking back and forth. Just because my cursor doesn't move doesn't mean we're not looking back and forth. Adjustments to income. Now that's new. We didn't have, well, we did actually have some for the alimony that was paid, but now that changed to 28.5. That looks good. Line 11, adjusted gross income is $74,912. That matches. Standard or itemized deductions, $30,370. We got it. Qualified business income deduction, $70, which still good. And then 12 and 13 are 30,440. We're good. Taxable income is 44,472. We'll move on to the next page. 2809. We're good. $500 for line 19. We're good. Let's just jump to line 24. 1909. We're good. Line 25D, 7502. We're good. And then the bottom line looks like on 35A, it's 5593. So let's go ahead and look just to make sure everything looks okay. This is going to be Schedule 1. We'll click on Schedule 1. And negative 106, 4,000, 4,000. There was this gambling 5750. We already had that. Activity not engaged for profit. We had already entered that. So this is income. We didn't make any changes to the income, but it was on page 2. Adjustments. We did make some adjustments here. We already had the 12,000 of alimony paid. The 14,000 is new. That 14,000 that's added, it's into the tax return as it should be. The student loan. Now, even though we entered the total amount of student loan, I think we entered it. Student loan 3122.45. The system computed that the maximum amount that can be deducted is 2,500. So that's what's listed. We're good to go. 26, 28.5. You see, we're good. Let's go on to the next schedule, Schedule 3. Now, we didn't even have to worry about this credit, but once we entered the IRA contributions, depending on the income amounts, certain taxpayers will qualify for a contribution credit. And this is computed through the form 8880. The good news when we're using software today, we don't really have to worry too much about that, because once we entered the traditional IRA contributions, it automatically the system automatically computed that they were eligible for $400 credits. We'll take a look at the form 8880 in just a bit. Okay, so everything looks good here. We'll move on to the next form, Schedule A. This was a big one for us. Schedule A, the total medical expenses, $82.67. That worked out perfectly. Now, even though their total medical expenses were $8,267, medical expenses can only be deducted if they are above 7.5% of your adjusted gross income. Now, we looked earlier, the AGI, or adjusted gross income, was computed to be $74,912. Well, 7.5% of that is $5,618. So we're going to take the total amount of medical expenses, deduct the amount that is not deductible, and anything above that becomes deductible. So even though they had $82.67 in medical expenses, of that, $2,649 are actually deductible. Taxes, $37.50. That matches what we entered. That was the sales tax. Real estate taxes, $7,000. That matches. The total is $10,750. This was another provision that kicked in 2018. The maximum amount of taxes you can deduct is $10,000. So even though the total was $10,750, the maximum is $10,000. So that's what the Gators were able to deduct, $10,000. Interest paid, this was the home mortgage, $10,821. That matches. They also received the deduction for $300 of investment interest. So the total is $11,121. Contributions of $600 in cash and $250 of non-cash, $850 in total. And then this is where the deduction for gambling losses, but it was only to the extent of winnings, and that's $57.50. The total amount of itemized deductions end up being $30,370, which we already knew that because that's what flowed through to the 1040. Schedule B, no changes. Let's just look at the totals: 1422, 1422, and 2121. Schedule C, no changes to that. Let's go look. Negative 106, negative 106. Schedule D, first page. 16,165, 16,165. Second page, 15,365. 15,365. Okay, we're good. 89.49. These are the detail to the D's. We've already gone through this. Schedule E, I guess we can take a look at it real quick. Bottom line, 4,000, 4,000. 8812, credits for qualifying children. That was at the very beginning. We've taken care of that. And then 8880, this is that form that I mentioned to you earlier. There's a computation and limitation of how much you can earn in credit. The computation is based upon what your adjusted gross income is. And then it appears it's going to be, after limitations, the total amount that's eligible is 4,000, and then you take that and multiply it by 10% based upon the filing status. A little more complicated than you would expect it to be, but there you go. So you let the form go ahead and flow through, and it ended up with a $400 credit. So that's how we got the credits. Anyway, I think we're good to go. I think we've completed chapter 5, and we are now ready for chapter 6.